Coming up today on Retirement Made Simple, healthcare, long-term care, and housing are almost sure to be big-ticket expenses for your retirement. But will they be your biggest expense? Today, Jeff not only helps you identify what could be your largest retirement expense, but also gives you ways to help you reduce that cost. Plus, you'll walk away from today's show with a list of your next steps to start making a difference for your financial future. The Retirement Made Simple show starts right now.
This is Retirement Made Simple with E.A. Buck. E.A. Buck focuses on finances, preservation, and retirement. Led by Chief Executive Officer Katie Buck and Chief Investment Officer Jeff Buck, E.A. Buck helps you grow and preserve what you've worked a lifetime to build. Each week, Katie and Jeff help you tackle some of the biggest challenges in retirement, including retirement planning, retirement taxes, wealth management, Social Security, and navigating federal benefits. Welcome to Retirement Made Simple.
Thanks for joining us today. I'm Amy Sharp here with Jeff Buck. The last thing you want is to make a misstep with the money you've worked so hard to save over the years. Today, we want to help you identify one of your biggest expenses in retirement. We're also going to share strategies to help you keep more of your hard-earned money in your pocket. That's what it's all about, isn't it, Jeff? Welcome.
Thank you, Amy. It's great to be here. I know we have a lot to talk about.
We absolutely do. This is an important topic. Let's get right to it. If it's not healthcare, if it's not long-term care or housing, what could be our biggest expense in retirement?
Well, what I find is a lot of my clients, they find it shocking to find out that it's actually taxes that may be their largest or their biggest expense in retirement. I think the reason is pretty simple. When you're working, you might be receiving a paycheck every 2 weeks, and everything's kind of automated. Taxes are being withheld, you're funding your 401k, and you're spending what's left over. But when you get to retirement, it might look completely different with multiple sources of income, and you're not exactly sure how much should you withhold and from which accounts and where do you draw income from to avoid those mistakes. And so because of that, it gets just a little bit more complicated, and that's why you might want to have a plan in place.
Once we get to retirement, we do need multiple sources of income coming in. Like you said, that paycheck no longer coming in the mail. Wish we could get that changed eventually, but I don't think it's going to happen. How do we know how those different sources are taxed? What does that look like?
Well, I probably can't really fully answer that question here in this one session, but what I would just suggest is there's multiple sources of income, and a common source that many people are receiving right away when they start retirement is Social Security. And a lot of times people think that Social Security is fully not taxable, so that maybe they're just going to receive that distribution and those benefits and not have to pay taxes on it. And unfortunately for most, it's up to 85% taxable. What that means is essentially that for some individuals receiving the benefits, they don't pay any tax on their Social Security. And for others, they will have 85% of it taxable. So it's important just to understand where those thresholds lie and what the provisional factors are that apply towards what's taxable. Another part to the retirement income sources that's taxable is IRA and 401k money. And when you think about that, really, you think about 1979 or early 80s when the 401k was first birthed, and then you think about the IRA, and these baby boomers, they were all told what? Go put as much as you can away pre-tax into retirement. So you avoided the tax then, but now you've got these hopefully sizable accounts that are pre-tax that you're going to be taking distributions from through retirement. And even if you don't want that distribution, sometime between the age of 70 and a half and 75, you're going to have to start taking distributions, and they're called required minimal distributions. And that all is dependent on which year you're born. But those distributions, those are going to be considered as fully taxable as well as ordinary income. Then, if you're fortunate and you have a pension, outstanding. And you probably realize if you have that pension, that too will likely be taxed as ordinary income. And then, of course, there's dividends and capital gains that have to play a role. And in some cases, we can help clients to avoid the tax on those, depending on what brackets they're in. And in other cases, they may find that they're actually taxed at rather large brackets. So it's all something that just has to be put into the plan, so to speak.
You say there's another key point that we need to really keep in mind when we talk taxes in retirement. I can't imagine anymore. There's so much to this topic, isn't there?
I think that's an important question, and I would just suggest that you be proactive in retirement. If you think about it as the form of a doctor, I went 10 years actually without having a primary care physician. And when you're in your 30s and early 40s, you're like, I'm fine, I get sick, I'll just go to urgent care and take care of it, right? Finally, I was convinced to go hire a doctor, but I didn't just hire a doctor. I went out and I found one of those specialists, those MD VIP doctors, and you pay a little bit more, but in return, you gain access to 24/7 services and someone that really understands your medical condition. And not only that, they spend a couple of hours with you every year running in-depth results. And I will tell you, in the last few years since I've been working with this particular physician, my health has improved. And I think the same probably applies for many people when it comes to retirement and their planning. If they're working with somebody that can help create a financial plan and can help look at their tax situation and understand it, they may find that their financial health will improve too.
I think that is a great analogy. I'm glad you're doing well. 10 years is a long time.
I maybe got lucky.
Now you're at optimal health. We want the optimal retirement for people as well. Thanks so much. Stick around. We've got more to come. Up next, strategies to help you be proactive on taxes to help reduce their impact on your retirement. And later, Jeff is in the hot seat for Retirement IQ. Stay tuned.
When it comes to planning for the future, time may not always be on your side. Think about your taxes. Tax rates are historically low right now, but they'll likely be higher in the future. Our current tax rates are set to expire in just a few short years. With the right planning and strategy, you might be able to cut your tax bill in the years to come. But don't wait until it's too late to take advantage of today's lower tax rates. Let us be your partner in planning for tomorrow so you can enjoy your retirement today.
On the surface, your retirement plan might look solid. With your 401k or IRA, Social Security, investments, and insurance coverage, you appear to have it all covered. But what could you be missing? Below the surface, is your retirement exposed to too much risk? It's time for a deeper dive into your portfolio. We can help you uncover the risk that lies beneath the surface and learn about strategies to help preserve your savings. Get your free risk analysis today.
Planning for retirement can be complicated. Helping create income that lasts, making sure your health care is covered, investing while managing risk, and don't forget about taxes. If you're overwhelmed, you're not alone. The good news is we have what you need to give you confidence to start planning for your ideal retirement, all in one convenient resource. You'll get answers to some of your biggest retirement questions in this easy-to-understand, practical resource. And best of all, there's no cost to you. Take the first step toward a confident retirement and get yours today.
How does your future look in retirement? When you don't have a strategy, the future might look a little fuzzy. But with someone asking the right questions and helping you learn where you truly stand, it can become easier to work towards your goals. You need a plan to help generate income that will last as long as you need it. And the first step to creating an income plan is an analysis of where you are now. Let us help you bring your retirement into focus with your free income analysis today.
Welcome back. I'm here with Jeff Buck of EA Buck Financial Services, and today we're helping you, the viewer, understand the potential impact of taxes on your retirement. And Jeff, we want to talk about strategies to help us be proactive. That is a lot of what we hear nowadays is like looking forward, being proactive when it comes to taxes. What does this mean?
Well, I would say it starts with just understanding the difference between tax planning and tax preparation. I've been in the industry for 20 years. My father started EA Buck back in 1980 with the whole premise of teaching the masses as much as he could around the tax code. And the reason was pretty simple. Back in the 70s, when he was making a lot of money running a company internationally, the highest tax bracket was 70% for all of the 70s. So he wanted to find ways to help reduce his tax liabilities legitimately, legally, and he did so through tax planning. The difference really between tax planning and tax preparation is that with tax preparation, you're, after the year has ended, collecting all of your data and then providing that data to your accountant, your CPA, or maybe you're downloading some software and doing it yourself. And what you're doing is you're filing your taxes, which is an obligation that every American citizen has to do. The difference between that and planning has to do with it. We're actually in the middle of the year and we're looking at a current plan that may be able to help to reduce the tax liability that year or in future years by making small shifts within the way that someone could be investing. The other way is we look years ahead and we might say, hey, let's look today at what's going on and let's see what we can do for the future that might better your financial situation or potentially reduce your tax liabilities later.
I like the sound of this. I know our viewers do as well. Let's talk about strategies to help us reduce that tax bill. Everyone's all ears when it comes to that concept. What's first? What do we need to look at first?
Yeah, that's a great question. It's hard to say what's first without knowing exactly what the needs are of the individual. But I'd say there's a couple things that come to mind. One is I do commonly come across retirees that maybe in their late 50s or early 60s. And at that time, they're retiring and there might be a gap between their retirement date and when they start Social Security. And if that's the case, then they could be in a relatively low income bracket during that period of time. So it might make sense to then take distributions from pre-tax accounts, pay the taxes to help fill a gap during those few years while they're in very low tax brackets. The other thing that I would suggest that people consider in that type of situation, where they're in a gap period where they do have lower income and lower tax brackets, is a lot of people don't realize that dividends or capital gains may be tax-free depending on the total income for the household. And we might want to identify portions to liquidate to then realize tax-free a gain or generate dividends that can help to offset income needs and do so tax-free or at a low tax bracket.
Okay, what's a strategy for people who have money in a tax-deferred account? They're worried about tax rates being higher when they have to start taking that money out.
Great question. Right now there's a buzzword and it's Roth IRA or Roth conversion. This is something that we personally have been helping clients as a firm for many years with. A lot of people don't have really a lot of clarity around what the Roth IRA is, but just understand that if you funded money into a pre-tax account throughout your lifetime, whether it's a 401k, whether it's an IRA, or some other vehicle that's pre-tax, that all of those contributions have avoided taxes today. So you put your money in maybe in 2000, you deposited $10,000, you avoided a tax liability during that period of time. Now that $10,000 has grown to hopefully a much larger amount, but at some point you're gonna have to pay taxes on that money. And whether you do it or whether you leave it to your heirs to pay taxes on, we might want to consider taking some of your IRA or all of your IRA over time and converting it to a Roth IRA. And by doing so, the primary difference is you're going to so-called lock in that tax in the year that you do the conversion because you're obligated to pay the tax liability at whatever your brackets are. So it's really important that you have somebody run a tax projection for you in the year that you plan to do the conversion so you can identify the tax brackets that you would be subject to for that conversion. Maybe it's a 12% bracket, maybe it's a 22% bracket, maybe it's a 24% bracket, but what you might want to avoid is inadvertently converting too much in one year, subjecting yourself to a 32% or higher tax bracket. So Amy, I think the point is that it can be rather complicated, and I think it's really important that before anybody goes out and tries to do a Roth conversion or modify their retirement accounts in any manner, they really should be getting advice from their CPA, their accountant, and be working with a financial planner that truly understands what's going on behind the scenes when it comes to the tax planning aspect of their retirement accounts.
Absolutely. We're giving you a lot of an insight today. Jeff is really diving deep into taxes and what that means for your retirement. And it's a lot to take in. But like you said, having someone by your side, this also fits into the comprehensive plan that you are working with your clients every day. So that's a piece of it, isn't it?
Absolutely. I think it's really important that when you're working with a financial planner, that it's a lot more than transactional. It really needs to be focused around the individual needs of the client, the risk tolerance of the client, the timelines, the importance of their estate, possibly with their beneficiaries, and then coupling all of that around the tax code. and that you're working with somebody that understands the tax code and can at least guide you along the way while hopefully working with their CPA or EA.
It doesn't sound like a DIY project to me personally, but some people maybe?
I do find people that come in the door and absolutely, and that's fine. We're happy to give some high-level advice there and at least give them some direction. But if you're anything like me, I'm going to be good at what I'm good at, and I'm going to rely on other people to be great at what they're great at.
That's well said. All right, thank you so much. Straight ahead, Jeff is in the hot seat for Retirement IQ. And later, what are some simple, actionable steps you can take to help improve your financial future today? Jeff has your checklist challenge. Stay with us.
How does your future look in retirement? When you don't have a strategy, the future might look a little fuzzy. But with someone asking the right questions and helping you learn where you truly stand, it can become easier to work towards your goals. You need a plan to help generate income that will last as long as you need it. And the first step to creating an income plan is an analysis of where you are now. Let us help you bring your retirement into focus with your free income analysis today.
On the surface, your retirement plan might look solid. With your 401k or IRA, Social Security, investments, and insurance coverage, you appear to have it all covered. But what could you be missing? Below the surface, is your retirement exposed to too much risk? It's time for a deeper dive into your portfolio. We can help you uncover the risk that lies beneath the surface and learn about strategies to help preserve your savings. Get your free risk analysis today.
When it comes to planning for the future, time may not always be on your side. Think about your taxes. Tax rates are historically low right now, but they'll likely be higher in the future. Our current tax rates are set to expire in just a few short years. With the right planning and strategy, you might be able to cut your tax bill in the years to come. But don't wait until it's too late to take advantage of today's lower tax rates. Let us be your partner in planning for tomorrow so you can enjoy your retirement today.
Planning for retirement can be complicated. Helping create income that lasts, making sure your health care is covered, investing while managing risk, and don't forget about taxes. If you're overwhelmed, you're not alone. The good news is we have what you need to give you confidence to start planning for your ideal retirement, all in one convenient resource. You'll get answers to some of your biggest retirement questions in this easy-to-understand, practical resource. And best of all, there's no cost to you. Take the first step toward a confident retirement and get yours today.
And now it's time to put our knowledge to the test with this week's Retirement IQ. Are you ready for this, Jeff?
I sure am, Amy.
Are you sure you're ready for this?
I think I am at least.
Okay. Well, this is a true or false question. Social Security is a tax-free source of income in retirement.
Well, I think many of us wish Social Security was tax-free, but the answer is, for most, absolutely not. Up to 85% of one's Social Security is taxable, and that's based on your provisional income. I will say about 30 years ago, it was up to 50% was taxable. And in the early 90s, that was increased to up to 85% of your Social Security income is taxable.
We've talked a lot about taxes today, so yeah, that's kind of a bad news answer there, but it's
for a lot of people,
the way it is.
But there are certain things that can be done to help potentially, at least for a few years, take advantage of possibly receiving some of it tax-free or at a lower bracket.
Okay, let's get a little more lighthearted here. This says, this is true or false, California first imposed the jock tax against athletes from other states in 1991 after Chicago beat Los Angeles in the championship. The jock tax. Have you heard of this? I know you have athletes in your family. You're an athlete, right?
I'm personally, I wouldn't say I'm an athlete. I'm pretty good at my sport, which is finance and managing money. But besides that, it's interesting when you say jock tax. That brings me back to the early 90s, and it brings me back to, I think, Chicago and something happening. So what is the answer?
That's for you to say.
Yeah. Well, I'm going to go with true, but I don't really like it.
You are right. True. No, that is correct. Illinois enacted a similar law to tax players who came to Chicago. It didn't take long before other states followed suit. So you're right.
Well, I just hope AYSO doesn't do the same thing, given all of my kids and the
I
fact
was
I've
gonna
got
say.
7 of them, and a few of them are still going through that level of soccer
You
and
have
sports.
a few athletes in your
So,
family. I just assumed it came from you, Jeff.
Yeah, absolutely.
No? Okay, you're not going to take
I'm
credit for
going to
it.
give that to my wife.
Okay, very good. True or false? This next question. West Virginia charges a safety fee on top of a regular sales tax when you buy fireworks. I think this is great. I might have given the answer away just then. But
Well, the fact you said it was great tells me it's a yes. It's true. It does seem logical, and actually spending a lot of my time in Hawaii growing up, I will tell you that things get a little crazy on certain times of the year, and the fireworks are just atrocious. I mean, so cool to see, but that makes sense. So tell me a little bit more.
Yeah. It's a 12% safety fee in addition to the sales tax rate. The revenue goes to the state's Fire Protection Fund, makes sense,
Yeah.
and Veterans Facility Support Fund, also good. And I'm with you. I can take just so much of the fireworks, and then that's enough.
Yeah, but I can also only take so much of the tax.
There
And
you
so
go.
it seems like we've got an excuse or a reason to tax just about everything these days. I really look forward to seeing what 20 years looks like from now.
Well, here we go. Here's more tax talk. True or false? The IRS tax code is nearly 10,000 pages long. That seems like a big read.
Well, fortunately, I've had a lot of history just working with the planning side and working around taxes, so I could tell you that that is false. It's not 10,000 pages. It's actually in excess of 75,000 pages.
Yes.
But that does include the case law and supporting documents behind it. Seems a little excessive in my opinion. What's the goal really at the end of the day?
As long as you've read every single page, right?
I
so that we
will not
don't have to do the reading.
Say that I read every single page, not at all, but just think about that, 75,000 pages just around taxes. And I think the bottom line is it's pretty simple. Understanding the federal government, they're not out in the world of making money, they're out in the world of generating tax off of those that make money.
Makes sense. And I think after all the tax talk today, that was kind of a want to end on, but that's okay.
Yeah.
You brought it around, and we'll have more fun to come. All right, thank you so much.
Thank you.
Still to come, you'll learn some of the simple steps you can take today to potentially help you improve your situation. Because how useful is knowledge without action? Stay tuned.
On the surface, your retirement plan might look solid. With your 401k or IRA, Social Security, investments, and insurance coverage, you appear to have it all covered. But what could you be missing? Below the surface, is your retirement exposed to too much risk? It's time for a deeper dive into your portfolio. We can help you uncover the risk that lies beneath the surface and learn about strategies to help preserve your savings. Get your free risk analysis today.
Planning for retirement can be complicated. Helping create income that lasts, making sure your healthcare is covered, investing while managing risk, and don't forget about taxes. If you're overwhelmed, you're not alone. The good news is we have what you need to give you confidence to start planning for your ideal retirement, all in one convenient resource. You'll get answers to some of your biggest retirement questions in this easy-to-understand, practical resource. And best of all, there's no cost to you. Take the first step toward a confident retirement and get yours today.
When it comes to planning for the future, time may not always be on your side. Think about your taxes. Tax rates are historically low right now, but they'll likely be higher in the future. Our current tax rates are set to expire in just a few short years. With the right planning and strategy, you might be able to cut your tax bill in the years to come. But don't wait until it's too late to take advantage of today's lower tax rates. Let us be your partner in planning for tomorrow so you can enjoy your retirement today.
How does your future look in retirement? When you don't have a strategy, the future might look a little fuzzy. But with someone asking the right questions and helping you learn where you truly stand, it can become easier to work towards your goals. You need a plan to help generate income that will last as long as you need it. And the first step to creating an income plan is an analysis of where you are now. Let us help you bring your retirement into focus with your free income analysis today.
Thanks for joining us today on Retirement Made Simple with Jeff Buck. Today, we're helping you, the viewer, understand the strategies that could help you possibly reduce your tax bill in the future. I think we've all learned a lot today, and as the saying goes, knowledge is power. And I'm joined once again with Jeff as we conclude our show today. I think like I said, knowledge is power. You've given everyone a lot to think about, and now you've got a checklist for them.
I do, and I would just suggest that knowledge is only power once it's been applied. So taking some of this information and hopefully being able to apply it to your personal situation is probably the most important piece of advice I can give you today. When you think about it and you think about some of the steps that you could be taking, I'll just give you very clear ones. Number one, start with an inventory of all of your assets and identify them. Maybe think about it as 3 buckets of money. How much money do you have that's in after-tax accounts like bank accounts? How much do you have that's in pre-tax accounts like IRAs and 401ks? And then how much do you have that's possibly in a Roth IRA, which would be considered possibly a tax-free account for you in the future? And if you find that that Roth IRA is really the smallest of all of those buckets, ask yourself, should you maybe be correcting that? Would you rather have more money in the bucket that's tax-free and less money that's in that bucket that's fully taxable? And that's where you want to work with your financial planner. Hopefully you have a planner that understands the tax laws and can work with you on that. And you also want to come back and just quickly do a forecast of your future tax liability by running a tax projection today and then looking ahead 1 year, 3 years, maybe look into your future when you have required minimal distributions and you're forced to take those distributions, and identify how much income might you have in the future that's taxable. And then last, with regards to the 3 ideas, is think about it and just understand this might be a little bit of an uncomfortable one. And that is, if you're married, there's a very high probability that one of you will outlive the other, and at that time, you would then be filing potentially single as a widow versus married, and that can have a dramatic impact on your taxes in the future.
Jeff, thank you so much. Great insight today, as always.
Thank you as well, and just know that we're here as a financial planning firm that's been in business for more than 40 years to help you and to provide you some guidance. So if you don't feel that you have that guidance now, you might want to give us a call or shoot us a text.
All right, Jeff, thank you so much. The retirement landscape is constantly changing, and Jeff and his team are here to stay on top of all the latest news so you can spend your time doing what you love with the people who matter most to you. For Jeff and the team at EA Buck Financial Services, I'm Amy Sharp. Have a great week, and we'll see you next time.